International financial markets. This chapter explores the two interrelated systems that comprise the international financial markets, which are the international capital market and the foreign exchange market. The learning objectives are to discuss the purposes, development, and financial centers of the international capital market, describe the international bond, international equity, and euro currency markets, discuss the four primary functions of the foreign exchange market, explain how currencies are quoted and the different weights given, identify the main instruments and institutions of the foreign exchange market, and explain why and how governments restrict currency convertibility. Capital market. A capital market is a system that allocates financial resources in the form of debt and equity according to their most efficient uses. Its main purpose is to provide a mechanism to borrow or invest money efficiently. The purposes of national capital markets. National capital markets help individuals and institutions to borrow money from lenders. Intermediaries exist to facilitate financial exchanges. The role of debt. A debt is a loan in which borrower repays borrowed amount, the principal, plus interest. Company debt normally takes the form of bonds, which are debt instruments specifying the timing of principal and interest payments. The holder of a bond, the lender, can force the borrower into bankruptcy if payment is not made on a timely basis. Bonds to fund investments are issued by private sector companies and by municipal, regional, and national governments. Role of equity. Equity is part ownership of a company in which the equity holder participates with other parts owners in the company's financial gains and losses. Equity normally takes the form of stock, which are shares of ownership in a company's assets that give shareholders a claim on the company's future cash flows. Shareholders may be rewarded with dividends or by increases in the value of their shares. They may also suffer losses through decreases in the value of their shares. Dividend payments are not guaranteed, but decided by the company's board of directors and based on financial performance. Shareholders can sell one stock and buy another or liquidate exchange stock for cash. Liquidity refers to the ease with which bondholders and shareholders convert investments into cash. International capital market. The international capital market is a network of individuals, companies, financial institutions, and governments that invest and borrow across national boundaries. Large international banks gather excess cash of investors and savers around the world and then channel it to global borrowers. The international capital market expands the money supply for borrowers. Companies unable to obtain funds from investors in the domestic market seek financing in the international capital market. This option is essential for firms in countries with small or developing capital markets or emerging stock markets. An expanded supply of money benefits small companies that might not get financing under intense competition for capital. The international capital market also reduces the cost of money for borrowers. An expanded money supply reduces the cost of borrowing. The price reflects supply and demand. Excess funds create a buyer's market, forcing interest rates lower. Projects regarded as infeasible because of low expected returns might be viable at a lower financing cost. The international capital market reduces risk for lenders. It expands the available set of lending opportunities. Investors reduce portfolio risk by spreading their money over many debt and equity instruments. Investing in international securities benefits investors because some economies are growing while others are in decline. Forces expanding the international capital market. Three main forces are expanding the international capital market: information technology, deregulation, and financial instruments. Information technology reduces time and money needed to communicate globally. Electronic trading after close of formal exchanges facilitates fast response times. Deregulation increases competition, lowers cost of financial transactions, and opens many national markets to global investing and borrowing. Yet, greater regulation flowing out of the credit crisis of 2008 and 2009 may curtail growth in this market. Financial instruments. Increased competition is creating the need to develop innovative financial instruments. Securitization is the unbundling and repackaging of hard-to-trade financial assets into more liquid, negotiable, and marketable financial instruments or securities. Here, too, regulation of securitization may curtail growth of this market. World financial centers. The three most important financial centers are London, New York, and Tokyo. They are economically and politically stable, are advanced in telecommunications, offer large amounts of funding in many currencies, and provide a less costly source of financing. Offshore financial centers fall into two categories. The operational centers see a great deal of financial activity, such as London for currencies, Switzerland for investment capital. The booking centers are usually located on a small island nation or territory with favorable tax or secrecy laws. Funds pass through on their way to large operational centers. They are typically offshore branches of domestic banks used to record tax and currency exchange information. What key factors are driving growth of the international capital market? First, the use of information technology is drastically reducing the cost of global communication. Second, deregulation increases competition, lowers the cost of financial transactions, and opens national markets to global investing and borrowing. And third, innovative financial instruments are increasing the number of options available to lenders and borrowers. Let's now take a closer look at the main components of the international capital market. The international bond market. The international bond market consists of all bonds sold by issuing companies, governments, and other organizations outside their own countries. Buyers include medium to large-size banks, pension funds, mutual funds, and governments. Types of international bonds. A euro bond is issued outside the country in whose currency it is denominated. For example, a bond issued in Venezuela in US dollars and sold in Britain, France, and Germany. It accounts for 75 to 80% of all international bonds. The absence of regulation reduces the cost of issuing a bond but increases its risk. A foreign bond is sold outside the borrower's country and denominated in currency of the country in which it is sold. For example, a yen-denominated bond issued by the German carmaker BMW in Japan's bond market. It accounts for 20 to 25% of all international bonds. Issuers must meet certain regulatory requirements and disclose details about company activities, owners, and upper management. Interest rates are driving growth in the international bond market. Borrowers from newly industrialized and developing countries borrow money from nations where interest rates are lower. Investors in developed countries buy bonds in newly industrialized and developing nations to obtain a higher return. Many emerging countries see the need to develop their own national markets. Volatility in currency market hurts projects that earn funds in those currencies and pay debt in dollars. International equity market. The international equity market consists of all stocks bought and sold outside the issuer's home country. Companies and governments issue equity and buyers include other companies, banks, mutual funds, pension funds, and individuals. Four factors lie behind the growth in the international equity market. Spread of privatization. A single privatization often places billions of dollars of new equity on stock markets. Increased privatization in Europe is expanding worldwide equity. European Union integration has made investors willing to invest in stocks from other European nations. Economic growth in emerging markets. The growth in newly industrialized and developing countries contributes to growth in the international equity market. Because of a limited supply of funds in emerging economies, the international equity market is a major source of funding. Activity of investment banks. Global banks facilitate the sale of stock worldwide by bringing together sellers and large potential buyers. This method of raising funds is becoming more common than listing a company's shares on another country's stock exchange. Advent of cyber markets. Cyber markets are stock markets consisting of online global trading activities that allow listing of stocks worldwide for electronic 24-hour trading. Euro currency market. All the world's currencies banked outside the countries of origin are euro currency and trade on the euro currency market. It involves large transactions by the largest companies, banks, and governments. Deposits originate primarily from four sources: governments with excess funds from prolonged trade surplus, commercial banks with excess currency, international companies with excess cash, and extremely wealthy individuals. Euro currency market is valued at around $6 trillion, with London accounting for about 20% of all deposits. The appeal of the euro currency market is the complete absence of regulation, which lowers cost. Banks charge borrowers less and pay investors more, but still earn profit. It's also the low transaction cost because transactions are large. The downside of euro currency market is greater risk due to a lack of government regulation. Still, euro currency transactions are fairly safe because of the size of the banks involved. Foreign exchange market. A foreign exchange market is a market in which currencies are bought and sold and in which currency prices are determined. Exchange rates reflect the size of the transaction, the trader conducting it, general economic conditions, and sometimes government mandate. If the British pound is quoted in US dollars at $1.5054, the bank may bid $1.5052 to buy British pounds and offer to sell them at $1.5056. The difference is the bid-ask spread. Banks buy low and sell high, earning profits from the bid-ask spread. The foreign exchange market serves four main functions. Currency conversion. Companies use the foreign exchange market to convert currencies. Currency hedging. Currency hedging is the practice of insuring against potential losses that result from adverse changing in exchange rates. Companies use it to lessen the risk of international transfers and reduce exposure in transactions where a time lag exists between billing and receipt of payment. Currency arbitrage. Currency arbitrage is the instantaneous purchase and sale of a currency in different markets for profit. It is common among experienced foreign exchange traders, large investors, and firms in arbitrage business. Interest arbitrage is the profit-motivated purchase and sale of interest-paying securities denominated in different currencies. Companies use interest arbitrage to find higher interest rates abroad in government treasury bills, corporate and government bonds, and even bank deposits. Currency speculation. Currency speculation is the purchase or sale of a currency with the expectation that its value will change and generate a profit. It is much riskier than arbitrage because the value or price of currencies is quite volatile. Currency exchange workers in Tokyo, Japan, wear traditional kimonos on the first trading day of the year. The world's three largest markets for currencies are the United States, the United Kingdom, and Japan. Now pick the correct word to complete this sentence. The correct answer is B, hedging. Using the foreign exchange market to insure against potential losses from adverse changes in exchange rates is called currency hedging. How the foreign exchange market works. Quoting currencies. There are two components to every quoted exchange rate, the quoted currency and the base currency. In the exchange rate yen per dollar, the yen is the quoted currency, the dollar is the base currency. The quoted currency is always the numerator, and the base currency is always the denominator. Direct and indirect rate quotes. In the exchange rate 90 yen per dollar, the yen is the quoted currency. This is called a direct quote on the yen and an indirect quote on the dollar. In the exchange rate $0.011 per yen, the dollar is the quoted currency. This is called a direct quote on the dollar and an indirect quote on the yen. To derive a direct quote from an indirect quote, simply divide the indirect quote into 1. And to divide an indirect quote from a direct quote, divide the direct quote into 1. Calculating percent change. The exchange rate risk can jeopardize profits from current and future international transactions. Managers minimize this risk by tracking percent changes in exchange rates. Take PN as the exchange rate at the end of a period, a currency's new price, and PO as the exchange rate at the beginning of that period, a currency's old price. The percent change in the value of the currency is calculated with the following formula: PN minus PO divided by PO times 100. Suppose on February 1, the exchange rate between the Norwegian kroner and the US dollar was 5 Norwegian kroner per dollar. On March 1, the exchange rate stood at 4 Norwegian kroner per dollar. What is the change in the value of the base currency, the dollar? The left-hand portion of this slide shows that the value of the base currency, the dollar, fell by 20%. Cross rate. The cross rate is used when there is no access to the exchange rate between two nations' currencies, but we have the exchange rates for each nation's currency with that of a third nation. Cross rates can be calculated using either currency's indirect or direct exchange rates with another currency. This slide shows cross rates for several major world currencies. This slide demonstrates how to find the cross rate between the euro and the yen from their exchange rates with the US dollar. Spot rate. The spot rate is the exchange rate that requires delivery of a traded currency within 2 business days. The spot market helps companies to convert income from sales abroad into the home country currency, convert funds into the currency of an international supplier, convert funds into the currency of a country in which it will invest. Buy and sell rates. The spot rate is available only to banks and foreign exchange brokers. Small business people exchanging currencies at their local bank receive a buy rate, the bank's rate to buy a currency, and an ask rate, the bank's rate to sell a currency. For example, if a bank quotes you an exchange rate between dollars and euros of $1.268/78 per euro, it will buy dollars at $1.268 per euro and sell them at 1.278 peso per euro. Forward rate. A forward rate is an exchange rate at which two parties agree to exchange currencies on a specified future date. Forward rates represent traders' and bankers' expectations of a currency's future spot rate. They are used to insure against unfavorable changes in exchange rates. A forward contract requires exchange of an agreed-upon amount of a currency on an agreed-upon date at a specific exchange rate. A forward contract belongs to a family of financial instruments known as derivatives. Forward contracts are commonly signed for 30, 90, and 180 days into the future, but customized contracts are also possible. Swaps, options, and futures. The forward market has produced three additional types of currency instruments: swaps, options, and futures. Currency swap. Currency swap is the simultaneous purchase and sale of foreign exchange for two different dates. It is used to reduce exchange rate risk and lock in a future exchange rate. It can be viewed as a complex forward contract. Currency option. Currency option is the right or option to exchange a specific amount of a currency on a specific date at a specific rate. It is used to hedge against exchange rate risk or obtain foreign currency at a favorable rate. Currency futures contract. The currency futures contract is a contract requiring the exchange of a specific amount of currency on a specific date at a specific exchange rate, with all conditions fixed and not adjustable. A discussion question. Why is exchange rate risk important to companies involved in international business? Exchange rate risk is important because it can jeopardize profits from current and future international transactions. The foreign exchange market today. It is an electronic network of foreign exchange traders, currency trading banks, and investment firms among major financial centers. A single-day trading volume on the foreign exchange market is $4 trillion. Trading centers. The United Kingdom, United States, and Japan account for half of all global currency trading. London dominates the foreign exchange market for historic and geographic reasons. Important currencies. A vehicle currency is used as an intermediary to convert funds between two other currencies. Currencies most often involved in currency transactions are the US dollar, British pound, Japanese yen, and European Union euro. Key market institutions. Three key institutions comprise the foreign exchange market. The interbank market is the market where the world's largest banks exchange currencies as spot and forward rates. Banks act as agents for clients and turn to foreign exchange brokers who can obtain seldom trading currencies. Securities exchanges. Securities exchanges specialize in currency futures and options transactions. Securities brokers facilitate currency transactions on securities exchanges. Transactions on securities exchanges are much smaller than those in the interbank market and vary with each currency. Over-the-counter market. An over-the-counter market consists of a global computer network of foreign exchange traders and other market participants, but with no central trading location. Major players in the OTC over-the-counter market are large financial institutions and investment banks. The over-the-counter market has grown because of several benefits. Business people search for the institution that provides the best price for transactions. It offers greater opportunities for designing customized transactions. Managing foreign exchange. Global managers should observe several points to get the best deals on foreign exchange transactions. First, match the company's foreign currency needs with the best provider the company can afford. Second, major banks located in financial centers often have cost and service advantages over local banks. Third, consolidate individual money exchanges into larger ones to reduce fees. Fourth, get the best rate possible by developing relationships with big banks and monitoring fees charged. And fifth, technology can help reduce errors, speed execution, and reduce time needed to exchange currencies. Currency convertibility. A convertible or hard currency is one that trades freely in the foreign exchange market. with its spread determined by the forces of supply and demand. But some countries do not permit the free convertibility of their currencies. Goals of currency restriction. Countries that restrict the convertibility of their currencies may be trying to preserve nations' hard currencies to repay debts owed to other nations, preserve hard currencies to pay for imports and finance trade deficits, protect a currency from speculators, and keep individuals and businesses from investing in other nations. Policies for restricting currencies. Policies for restricting currency convertibility include demanding central bank approval of all foreign exchange transactions, requiring import licenses to control the amount of currency leaving the country in transactions, implementing multiple exchange rates that impose less favorable rates on the imports of certain goods or certain nations, issuing import deposit requirements that require business to place a portion of their foreign exchange holdings in special accounts before receiving import licenses, issuing quantity restrictions that limit the amount of foreign currency that individuals can take out of the country when traveling abroad. Counter-trade. Finally, one way to get around national restrictions on currency convertibility is counter-trade. It is the exchange of goods or services between two parties without the use of money. International companies can circumvent currency convertibility restrictions and yet conduct business. Fill in the blanks by choosing the correct word. The correct answer is C, convertible or hard. A currency that trades freely in the foreign exchange market is called a hard or a convertible currency. The bottom line for business relating to this chapter. Key components of international financial markets are the international bond, equity, and euro currency markets. Continued growth in the international capital market is expected. It is crucial that managers understand the fundamentals of exchange rates and how the foreign exchange rate market is structured. The next chapter covers how market forces, including interest rates and inflation, affect exchange rates. We explore the roles of government and international institutions in managing movement in exchange rates.